traders, and welcome to another installment of the Market Barometrics Macro Analysis series. In today's video, we're going to be talking about some of the key econometric data associated with U.S. trade and Fed action. Specifically, we're going to be looking at the U.S. trade balance, the Fed's balance sheet assets, the money supply, total public debt, and the debt to GDP ratio. Now, this is the kind of information that I like to use to get a kind of gauge the health of the U.S. economy, the strength of the U.S. consumer, and of overall demand here in the United States. This isn't the kind of thing that I look at every day as a trader and investor, but I like to check in on this, once a week, once a month even, just to gauge the general health and direction of the underlying macroeconomic trends moving the market. So without further ado, let's dive in and talk about some of the econometric data associated with U.S. trade and Fed action. Alright, so first up is the U.S. trade balance. Now, a trade balance in general just refers to the difference between a country's net exports minus their net imports. It gives you an idea of whether a country is importing more than it's exporting or exporting more than it's importing. Is it more important that a country exports more or imports more? That depends on a number of factors, most of which aren't really relevant to us as investors and traders trying to get an idea of the health of the U.S. economy. So we're going to stay on task with what matters to us as traders and investors and focus just on the U.S. trade balance and what that number tells us. So in general, when a country exports more than it imports, that amounts to a trade surplus, right? Whenever we're importing more than exporting, that equates to a trade deficit. So in the United States, we always run a trade deficit. Why is that? Well, because, the United States is one of the global superpowers. We have the most robust, strongest economy in the world. As such, we have a ton of demand in our economy. Because of that, the United States doesn't produce enough goods and services to fill the demand of its consumers. So, in general, the United States has to import more foreign goods to meet the demand of the U.S. consumer. So, our baseline is that we run a trade deficit. So what we're looking for as traders and investors trying to get an idea of the health of the economy is we're looking for fluctuations in the trade deficit. Is the trade deficit narrowing or is it widening? How I like to use this is I kind of think of the trade balance as a proxy for U.S. consumer demand. And, as an extension of that, I look at it as how strong is the U.S. consumer at any time. Our trade deficit is mostly a factor of the changing net imports in our country. So when we're importing more, that means that the U.S. consumer is demanding more. We need more products, more goods, more services to meet the demand of the U.S. consumer. That means that the U.S. consumer is healthy, has extra money in their pocket, right? So, the health of the U.S. consumer is a proxy for demand and is generally a good sign for our economy. So skipping over here to the market barometer, we can see the first graph here is the U.S. trade balance. I have it going back to about 1995 here. And we can see that this is a monthly reading and that generally, we're running a pretty deep trade deficit. But that trade deficit does kind of ebb and flow, right? It narrows and widens through time. So what's interesting is to look at times when we know the economy was doing bad and see how the U.S. trade balance reacted to that. And then kind of forecasting that forward to where are we now and where is the trade balance relative to where it's been. What's that telling us about where we are now? What jumps out to me about this graph is the Great Recession here between 2007, 8, 9. You can see that the U.S. trade deficit really narrowed significantly through this time. And that's kind of plays to my point where, our trade deficit is mainly a factor of the demand for the import of foreign goods here in the United States. You can see that demand really dried up during the Great Recession here. and the trade deficit narrowed at that time. So that's what I'm looking for, is times when the trade deficit is narrowing or widening. Narrowing indicating that the health of the U.S. consumer is kind of waning, and whenever it's widening, that means that there's more demand here in the United States. The health of the U.S. consumer is more robust. So another interesting time to look at is just earlier this year, 2020. February and March were kind of the beginning and into the meat of the coronavirus sell-off. You can see early 2020 here, there was a spike in the narrowing of the U.S. trade deficit, meaning that for that short time, U.S. demand for the import of foreign goods really kind of dried up. But, and that was a warning sign for the health of the U.S. consumer, and by extension, the health of the U.S. economy. So moving beyond that, though, we can see that the trade deficit widened again significantly since, beginning of April and here into early October is where we are now. I'd wager that that's probably a product of Fed stimulus in response to the whole coronavirus pandemic. So we can see that again, it looks like the health of U.S. consumer demand is spiking, is robust once more. Probably has to do with the fact that the Federal Reserve has been putting money back in the pockets of the U.S. consumer. So right now, what's the U.S. trade balance telling us? It's telling us that demand is strong and that the U.S. consumer is strong. So next up is the Fed balance sheet assets. So the Federal Reserve, again, is the central bank here in the United States. They're tasked with what's called a dual mandate. Basically, they're in charge of keeping inflation in check and to hit a target inflation growth number, and also to hit target employment, kind of ideal employment ratio. So those are the goals of the Fed, and they accomplish these goals through monetary policy, right? So they do things like set interest rates and manage the supply of money in the economy. They do this through kind of several tools that they have at hand. Namely, they can purchase and sell government securities, U.S. government treasuries specifically for the most part. They also can help influence overall kind of prevailing interest rates through the Fed funds rate, which is the interest rate they charge for short-term loans to their member banks. So what is this exactly? What is it telling us, and why is it important to us? Well, let's jump over to the market barometer and have a look. You see the Fed balance sheet assets is the graph over here on the left in the middle. What this is telling us is the total cumulative assets on the Fed's balance sheet. Now, those assets can include things like U.S. Treasuries, whereas their liabilities include things like the cash in circulation. So what this is telling us is, what is the Fed's current outlook of the economy, and how are they trying to influence economic productivity through acquisition of assets and through the assets it's holding on its balance sheet. So when the Federal Reserve is forecasting a dim outlook of the U.S. economy going forward, they might try to stimulate that economy by doing things like purchasing U.S. treasuries in what's called open market operations. When they do this, it puts more money in the hands of U.S. businesses and consumers because it injects more cash into the economy. When there's more cash floating around, there's more cash available for people to spend, then this boosts economic activity. So you can see kind of what's noteworthy about this chart here, and again, we're going back to the early 2000s. So we can see around the time of the Great Recession, 2007, 2008 here, you see there was a real spike in the total cumulative assets on the Fed's balance sheet at that time. It's because, that's when quantitative easing really started, when the Fed started going in and buying up all of these assets. What's interesting about the Federal Reserve and central banks in general is that when they want to expand their balance sheet, they can simply print money. They can create money out of thin air to buy assets. It's going to inject cash into the economy and stimulate economic activity. So you can see during the recession, they did a lot of that, you know. The total assets, total cumulative assets on the Fed's balance sheet really jumped up. It spiked during the Great Recession. Interestingly enough, you know, here we are in October 2020, only about 6-7 months out from the COVID-19 fallout. You can see again, you know, they really expanded their balance sheet recently, indicating a couple things: that maybe their economic outlook was a little fearful, which made sense given what was going on with the coronavirus stimulus and unemployment skyrocketing at that time. So they took to expanding their balance sheet aggressively once again in an effort to stimulate the U.S. economy. So what is this telling us right now? It's telling us that right now in October 2020, the Fed just recently completed another round of intense balance sheet expansion, right? Expansion of the assets on their balance sheet in an effort to stimulate the economy. So there's going to be a lot of cash injected into the economy available to the U.S. consumer. That should help boost demand here in the U.S. economy because the U.S. consumer is going to have more cash on hand. That also tells us that the Federal Reserve is slightly nervous about the economic outlook, and that, you know, because of that, they've been expanding their balance sheet. So there you have it, folks. A quick look at some of the econometric data points from the U.S. Trade and Fed Action page of the Market Barometer. We began talking about the U.S. trade balance, the Fed's balance sheet assets, and the total money supply. Stick around for the second part of this video, where we'll be talking about total public debt and the debt to GDP ratio, which give us even more clues as to the health of the U.S. economy and the likely direction of the economy moving forward. For now, go ahead and hit that like button and subscribe to our channel, and we'll see you guys in the next video.